Kerry Stokes' fortune was built on bold partial takeovers of media companies, largely funded by debt. In the background, though, was one of his canniest moves. That was to have the business WesTrac, which holds the franchise for Caterpillar trucks and equipment right across Australia. Today, Seven Group, which owns a 39% share of the Seven West Media business, is a $16 billion giant that includes Boral, Coates Hire, WesTrac, of course, and a share of Beach Energy. By contrast, Seven West Media is worth $227 million. Media is just 5% of the total Seven Group business today. But as I note right now, it's 95% of its reputational damaging publicity that is generated. In the past year, though, it's been strong for the Seven Group. And this week I sat down with Ryan Stokes to try and figure out the long-term plan for the business and perhaps also its interest in television.
Yeah, it's a really interesting question. We take a quite involved perspective as to how we look at how the portfolio of the group has evolved. We see ourselves as a diversified operating company, not a holder of assets. So we believe very firmly in the business we own. We want to make sure we operate very effectively, we unlock their potential and ultimately continue to drive ongoing performance. We've thought about how we want to allocate capital, and it's those three themes around mining production, infrastructure and construction, and transitional energy, which is domestic gas and LNG, where we want to play into, and that's how the portfolio has evolved over a number of years. But it's a very considered approach to that allocation, and we're a bit probably similar elements of Wesfarmers, but in our own take on that.
Okay, so you've taken over 100% of Boral in the last year. That was kind of opportune. The last time we spoke, I think the market cap of the business was $14 billion.
Yeah.
It's now $16 billion. So you've had pretty decent growth. You've been able to bring down your debts. Almost seems to me you might be getting set up for another big acquisition somewhere.
The unique nature of our group, Ross, is that the cash flow enables us to take on leverage and naturally de-lever. And that's why we think we can continue to grow. The next 12 months, we're focusing on how we de-lever the group, so we don't have anything on the horizon. But we have the capacity to grow. The businesses like WesTrac, Coates and Boral all generate strong cash flow. We could see opportunities to reinvest in aspects of each business, but ultimately the surplus cash we can put towards further growth aspirations. And that we see as an opportunity over the 12 months from now. Next 12 months, we're going to continue to execute our business. I mean, I think the only other thing I'd note is in the last 12 months, delivering the 20% EBIT growth, I think is another kind of hallmark of our group. In the last 10 years, 18% compound annual growth rate of EBIT has been this is not just a one-off. There's been a number of years where we've continued to perform.
So WesTrac has been the workhorse of this business for decades. But where does it go to in the next few years, especially when you've got big falls in nickel prices, in lithium prices, you've now got iron ore prices coming off? It could be that development starts to disappear from that sector.
Yeah, we're more confident in the resource sector and the resilience of it. Our customers are the world leaders as far as operational efficiency. That's going to be an important factor. Our business, WesTrac, is mainly exposed around the actual production volume, and that's why we talk mining production. The more earth that's moved, the more equipment wear and tear you get, and therefore the more the opportunity to serve that customer. But we see our customers probably as busy as they've ever been. 950 million tonnes of iron ore export in WA. We have strong coal exports in New South Wales. We have a lot of mining investment in lithium and other areas that we think will be more resilient, and gold is strong. So the outlook on the resource sector is more confident. Clearly, with price changes, there'll be a focus back on costs. But ultimately, our customers do lead the world as far as the cost of production.
And in terms of those Caterpillar trucks long term, what do you see in terms of changing them over? Is it electric motors? Is it hydrogen? Is it green hydrogen? Where does it go? You saw Twiggy Forrest this week out extolling the virtues again of green hydrogen, but where does Caterpillar fit into that?
Yeah, from a Caterpillar perspective, they're leading as far as the OEM development on a battery electric solution. At the end of the day, I think Caterpillar's view, our view, is we're going to develop the options for customers, and it's going to be what options customers want. What do they prefer? Do they want diesel, mechanical diesel, electric drive, battery electric, and provide them the best solutions. I think when we look at the conversion to battery electric, that is a pretty fundamental shift. It isn't just a truck, it's a whole electrification of the mine site. So we think that over time will become a viable option, but I suspect in the interim elements around battery electric solutions, but ultimately going to take a lot of thought process.
Have you got any thoughts also about the government? Right now you've got, as you say, the government trying to invest in electrification, but it's also, with its Future Made in Australia, trying to go into critical minerals, going into nickel and lithium are key in that, and yet it almost feels as though it's like government welfare for business, and that's a very unusual thing.
I mean, I think the US has probably set that in train with their IRA policy in supporting it and providing that kind of investment in business. I think there's an opportunity and a role for government to play to support burgeoning industries. And I think in suddenly critical minerals where you want to kind of create that makes sense. I think it's trying to draw the line where these industries are not going to be self-sufficient and continually reliant on government support. That's where I think you probably need to think through. But
I was going to say, if you were to make that acquisition in the future, somebody might need to go broke somewhere. That's the only thing I'm thinking as a business person. Isn't that the reality of the markets?
Well, the government stroke of the pen issue is a factor if you're reliant on that government subsidy and that dynamic. And you're right, ultimately supporting the emergence of an industry is valuable and it has a role, particularly if you want to keep that homegrown industry strong. But at some point, the industry needs to actually be able to survive without that government support.
You know, this is my perennial question. I've got to ask you about this, and that is that your interest in Seven West Media now is worth about 5% of the $16 billion value inside the Seven Group, and yet it creates about 95% of your reputational issues in terms of the commentary that goes. You saw Four Corners this week, of course, came out again. I keep asking you why you bother when it's such a small amount of your total portfolio these days.
We still believe that there's value opportunity with Seven West. There's new strategy that the CEO, Jeff Howard's implementing at the moment. That is actually going to reorientate, we hope, to show growth in digital and present more of an opportunity from an investment perspective. We'd like to see Seven West deliver stronger kind of growing earnings, cash flow, and start to fulfil that potential that we believe exists. So from our perspective, it's been a key part of the group for a long period of time. We haven't allocated capital there for a long time. We've been very consistent where we're deploying incremental capital.
But it's not like you're going to go bigger into media in the future, is it?
No, and we see the opportunity for Seven West to grow in its own right and look at other opportunities and acquisitions when it gets into a position where its performance is improved. It's been has been a pivot in strategy, and we think the new focus that Jeff's going to bring around the financial discipline and cost focus is an important step for Seven.
You've lived with this since you were a child. I mean, free-to-air television right now is dying, is it not? It's all about the digital streams and it's all about different forms of viewing. You'd have to say the traditional model of television, free-to-air, through the antenna, that's coming to an end.
Look, it's still a huge audience that's delivered through free-to-air. I think what we'd say is that's evolving, and I think that having an option for viewers to be able to kind of consume that content through video on demand, and particularly broadcast video on demand, that's what we're building and catering for. We've developed quite a significant audience in broadcast video on demand. How we effectively monetize that's something we need to rapidly improve, and I think we can. And then we've got a business that can show digital growth as well as having a traditional broadcast model that's viable. And if we end up in a position where we've got a highly profitable digital business that shows growth, an effective ability to monetize that, and overall profit growth in the company and cash flow, I think it's a very different story from an investment perspective, an investor perspective, and then I think it can start to fulfil that potential. But it's a priority for the team at Seven West. From a Seven Group perspective, I think our reputation is built more around what we've delivered on the industrials and the performance of the overall group. And investors have found the diversification of the portfolio and what we're focused on to be their primary interest. So we've found that.
So I'm agreeing with you on that, you see, totally. I've just got one last question about television. That is that. Is it getting to a point where free-to-air television stations and networks are going to find it difficult to afford sports rights going forward?
I think that's a broader question in relation to how to continue to fund an ever-increasing expectation around sports rights. I think we have to have an important discussion around how we ensure that they're available for free, because if we're not careful, then the only people that will be able to afford them will be some of the international streaming companies that will put that into an environment where they're going to restrict access, which I don't think is in the interests of the community. So the ability to ensure that they are affordable and that there is an opportunity for viewers to consume that for free is a really important avenue. And I think it's been one of the hallmarks of the success of sporting industry and broadcasters, the ability to ensure that there is a lot of sport available for consumers for free.
Ryan Stokes, always good to chat to you. Many thanks for your time.
Thanks, Ryan.